Welcome to everybody joining us this morning, and welcome back to those of you who joined us at our 9 a.m. webinar session. We are happy you made time in your busy schedules to attend the second week of the Illinois Soybean Association's Agribusiness Management Program Summer Webinar Series. I'm Linda Call, Director of Ag Innovations for the Illinois Soybean Association. For those of you attending the AMP webinar Summer Series session for the first time, AMP is a new program from ISA that provides farmers and ag professionals educational resources that include the latest agribusiness advice and guidance. The AMP webinar series is a free 5-week program where experts will present agribusiness topics including succession planning, grain marketing, and more. Today we have a session from Jesse Schutman and Emily Carls called Fun with the T Word. Before we get started, we wanted to review some housekeeping items to help make the best of this virtual experience. You can ask questions of the presenters or the ISA webinar staff utilizing the GoToWebinar dashboard on the right side of your screen. If you are having audio or technical issues, please alert the staff through the dashboard as well. We stand by to help. For any CCAs in the audience, if you stay with us for the entire presentation, you can earn 1 CEU in professional development. We'll have details at the end of the webinar on how to access your credit. Before today's speakers begin, I'd like to give today's sponsor, Country Financial, time to share a few comments. So, Joe Berman, thank you for joining us today.
Thank you, Linda. Good morning. Thank you for joining us virtually today. Country Financial and the Agribusiness Management Program teamed up to bring you a valuable and I think an eye-opening presentation. I'm Joe Berman, manager of our financial planning support teams here at Country. I lead a group of financial planners spread literally across the country that offer complimentary planning services to our clients and Farm Bureau members. As for me, my wife grew up on a family-operated farm. My grandfather farmed. I grew up in a family-owned grocery store and worked there for many years, so I understand the impact of taxes on a small business owner. At Country, we understand that just about every aspect of your life is impacted by taxes, whether it's the taxes we pay directly to our state and federal governments based on our income, or the taxes on our assets, retirement plans, investments, and insurance products that you own. Last hour, we learned about estate taxes from Polly Dodds, and while your assets may not be subject to estate taxes, your plan is nearly always impacted by income taxes. I don't think Ben Franklin could have been more relevant than today when he said, "Little in life is certain other than death and taxes." The Country, we understand how frustrating it is that the tax laws change every year. It's been a real whirlwind the last few years, whether it's been the Tax Cuts and Jobs Act, or even this year with the Secure Act and CARES Act. I think with today being July 15th, being the extended tax filing deadline, it's only fair that Jesse Schutman and Emily Carls join us to talk all things taxes. Jesse and Emily are Illinois Farm Business Farm Management Field Staff and AMP advisors, and we'll share with you what's new, different, and unique about taxes here for 2019 and 2020. Again, thank you all for being here. I look forward to the next hour. Please join me in welcoming Jesse and Emily.
So thank you, Joe, for those comments and helping us get kicked off on this second in a double feature webinar. Country Financial's support of this program, along with our other partners, is invaluable to its success. Now, without further delay, I'd like to introduce our speakers, Jesse Schutman and Emily Carls. Jesse and Emily are Illinois Farm Business Farm Management Field Staff, serving producers in Western Illinois. They provide farm business consulting, tax planning, financial statement review and analysis, education, and outreach. Both were raised on livestock and row crop operations in Western Illinois. Jesse has a master's degree in accountancy from the University of Illinois, Springfield, and Emily has a master's in agricultural economics from Kansas State University. They are also advisors on the AMP program for ISA. And with that, I'll hand over the presentation to you, Jesse and Emily. Thank you.
Hi, thank you. Thank you for having us. I'm just trying to get organized a little bit here so we can kind of see and make sure we're able to see our screens the way that we need to. So hi, everybody. Thank you so much for joining us today. I know sometimes taxes aren't the most exciting thing to talk about. So Emily and I spend a lot of time every year worrying about tax planning, as well as the general tax season, but also looking at information for farm owners and operators with their finances. So we help them create financial statements as well. Emily and I are located in the western part of Illinois over here near Quincy. That's kind of our biggest landmark, if you will. So our office is located in Camp Point. I grew up, as Linda mentioned, on a row crop and cattle operation just outside of town, about 5 miles here. So I was very fortunate to have that upbringing and have been working for Illinois FBFM since August of 2013. So very excited to be here with you today. I'll let Emily share a little bit about herself.
Yeah, absolutely. Thanks, Jessie. So like Linda said, I'm Emily Carls. I grew up on a row crop operation as well, just about an hour east of here in Cass County. So I grew up in the land of sand fields and irrigation, and now I work in a land of cattle and hills and not near as much irrigation. So I've been with FBFM since January of 2019, so just about a year and a half, and we're very excited to be here today. We know, like Jessie said, taxes are never a fun topic to talk about, but we're going to try to make it as fun as we can and interesting as we can today to give you the most up-to-date information that we have on all things that are happening in taxes in 2019 and 2020.
Yeah, another fun fact, I actually started in an office where Emily is from. So we have some strange ties to each other that we didn't know about until Emily started working in this office. So it was very, very fun, and we're glad to have Emily here. So as she mentioned, let's just go ahead and get started and jump right in. We're ready to talk about some taxes. Okay, so first we want to talk about the Tax Cuts and Jobs Act. So one of the big changes with the Tax Cuts and Jobs Act came for people who were self-employed, meaning they had some sort of a business. And that didn't necessarily have to mean that they had a farm operation, but generally speaking that they had some sort of business arrangement. So this thing called the Qualified Business Income Deduction is essentially a 20% deduction of your total or your net business income. So every business got to take advantage of that except for C corporations, and we'll talk about that a little bit later. So C corporations got something else. So we want to make sure that we can clearly identify that there were two different good things that came out of the Tax Cuts and Jobs Act for business owners. But this specific piece we're talking about right now is for everyone except C corporations. So the differences that we see now, so the QBID is actually going to be replacing what was called DPAD for our farmers. You still may get a 1099 that has something called DPAD on it, and that's just passed through to you from the co-op. So that was supposed to be going by the wayside, but they kind of resurrected it, and we see that on the tax returns that we work with now. And Emily, do you have anything you want to add about QBID today?
I don't think so. I think we can move on to the next piece of the Tax Cuts and Jobs Act, our next slide. So before the Tax Cuts and Jobs Act, the way we reported machinery purchases, if you had a trade-in, we just reported the net difference of that, which was called, like kind or 1031 exchange. So instead of having a full purchase price and a sale, you just had the net trade difference that you were able to deduct on your Schedule F. What part of what the Tax Cuts and Jobs Act did was disallow that for machinery sales. So like-kind exchanges are now only allowed for real estate property sales. So we have a little bit of an example here. It was a little frustrating, I think, at first, thinking that this was going to be not as beneficial to farmers as we originally thought. But when we look at it a little bit more, we see it's actually a huge tax savings for farmers. So is what reporting it in the last probably 2 years, when you've had a machinery trade, your tax accountant has probably asked, what's the full purchase price? What was your trade-in value? All details we did not need before the Tax Cuts and Jobs Act. So now is what we do is you get the full purchase price deduction on your Schedule F, but you have to report the trade-in value as gain on what's called a Form 4797. So while we think that might result in a higher tax due, it actually results in a lower tax due because the Form 4797 is only taxed at federal tax rates, It's not self-employment tax. So you get a larger deduction on your Schedule F, and you get a higher 4797, all results in lower self-employment tax and a lower tax due.
Yeah, so Emily is kind of bringing into this conversation right now something that we need to identify clearly and kind of just let you guys know there is a difference between the different characters of income. So as Emily mentioned, 4797 would be a form where we report what's called ordinary gain. So that just gets regular ordinary income tax rates attached to it. Some people have investment income. So those would be things like Fidelity investments, Country Financial investments, Edward Jones investments. And those would potentially have some capital gains consequences. So capital gains are a very favorable tax rate. That's a low 15% tax rate and possibly zero depending on what your taxable income is. So you want to make sure that you are discussing specifically with your tax accountant about the different characters of income. And as Emily mentioned, your farm income or your business income will have an additional tax on it called self-employment tax. So there are people in the world who make wages, just getting a W-2. They're an employee at a business, so they normally get wages every 2 weeks or every month. And those people have their self-employment tax or their Social Security and Medicare taxes paid in for them. So farmers and other business owners don't always have that. So generally speaking, you'll just want to make sure to be aware if you are new to farming or new to owning a business that you'll have an additional tax that you may not have been thinking about. So as we mentioned, just understanding the different types of income there are can generally give you a better idea of how your tax return works and will flow to give you hopefully the best tax liability or the least amount of tax liability possible.
Something else important to point out with this is as we can see in this example, with the new tax treatment of trades, we can sometimes see more negative Schedule Fs than what we would have before, which means you are not paying the self-employment tax. However, when we start talking long-term about Social Security benefits, if you're continuously just trying to not pay self-employment tax, that means you are not paying into Social Security, which could affect the benefits that you receive later when you start talking about retiring from farming or starting to take out your Social Security benefits. So that's just something to keep note of as you start thinking about long-term planning for tax purposes and Social Security benefits later on down the road.
Excellent point, Emily. So we want to come into our first poll question. So do you have an estate plan in place? And Emily and I work with a lot of different farm families across Illinois, and I have worked with a lot of farm families in central Illinois as well. And I have found that if someone does have an estate plan in place, it is so much better for the family moving forward, just because there are potentially some issues that can arise with people who don't have an estate plan. There could be questions, and then the heirs maybe just are left to each other and are frustrated. And those are kind of some of the horror stories that, Polly was mentioning in her first presentation. So we want to make sure that, you're just thinking about it, and you may not have all of the ideas nailed down when you start with your estate planning track. There's a lot to think about and a lot to consider. So just maybe having an idea of, yes, this is kind of what we think we want to do. Just going to talk to a lawyer and just talking through those things are extremely important. So we know it sounds like a big task and it could be a little bit scary, but at the same time, it could also help preserve wealth as well as just generally assets in your operations.
Yeah, absolutely. I mean, like Jesse said, Polly just talked about some of the situations that could arise from not properly planning for your estate. And I mean, I know it's very scary to think about all of the things that go into estate planning, but that's why there's people like Polly out there. That's why you have tax accountants like Jesse, myself, and others across the state and the Midwest to help with some of those things. We're the experts in those fields, and we're there to help you plan. So just having an idea of what you want the long-term plan, what the long-term goals of the operation are before you go to those meetings can really help whenever you start thinking about those situations.
Yeah, and of the people who voted, it looks like about half of them have estate plans, which trends pretty well the same with what we found in our research as well. So generally people across the US, about 50% or so, sometimes less, sometimes more, depending on the demographic that you're talking about. You know, more elderly people will probably have more of an estate plan, and some younger people maybe not so much. But yeah, this kind of tracks in line with what our general findings have been. So we'll go ahead and move on to a little bit more about estate tax planning. So with the Tax Cuts and Jobs Act, we saw that the federal exemption, the federal estate exemption, doubled to almost $12 million per person. So that is a huge amount. You would have to have lots and lots and lots of assets to get to the point where you would be over the estate exemption. That generally means if you're married, you can have up to $24 million roughly in assets before you would have to pay the estate tax. And there are some additional ways that you could do what's called port your additional exemption over to your surviving spouse after you pass. But those are some things, again, that you would want to have a discussion with a lawyer about if you do have a high estate. So just kind of understanding where your estate is very important. But we do have some much more favorable federal estate tax exemptions and regulations right now. The problem in Illinois is that we are probably not changing that exemption. I have not a lot of faith that we will change it. I wish that we would, just because we have assets. I mean, think about how land has appreciated just over the last 15, 20 years. The amount of land that you had back in 1980, you could have bought for $250 an acre, $500 an acre, and now think of the value. So the Illinois exemption remains at about $4 million. So if you have an estate that is a total asset of $5 million, your tax would still be about $285,000 just on your estate itself. So there are some very important reasons, especially when we're talking about dollars and cents after somebody passes away, that you would want to make sure you're doing that good estate planning and staying under those exemption limits to make sure that you're not just paying more estate tax than you need to.
Yeah, and as we kind of mentioned earlier, and I think Polly mentioned in her presentation as well, there's a lot of different goals that go into estate planning, and tax is sometimes one of those goals. So it's definitely not the overarching goal, but it's something to definitely be cognizant of as you start thinking about your estate planning, or maybe revising an estate plan that you have in place, that there are these exemptions and ways to help mitigate some of this tax. But just knowing what your options are by talking to an accountant and a lawyer can help give you some more information on that.
All right, so we're going to talk a little bit about what happened in 2019. So we've kind of closed the book on 2019, it feels like, but not really. I mean, we're still kind of, Emily and I usually live in the prior year for at least 4 months into the next year, just because we are doing taxes and still kind of living in the past, it feels like a little bit.
It's sometimes hard to keep track of what year we're actually in and what year we're actually talking about, because it's usually the previous year.
Yeah.
It's extended a little bit more this year, which we'll talk about here in a little bit.
Yeah. So we just kind of want to circle back to the thought about qualified business income deductions. So as you can see here on this slide, our taxable income rates as well as taxable income ranges are listed. But if you look on the kind of the right-hand side, the new business effective rate, so if you take 20% off of each of those federal tax rates, that's how you get your new business effective rate. Okay, so this does not include self-employment tax. This is only federal tax, and these are only for the married filing joint brackets. So we just kind of wanted to illustrate that here for you. And so we have that attached as a handout as well in our PowerPoint slides. So you can find that if you want to look back to it, but just wanted to show you what that looked like.
Yeah, and we'll talk a little bit about some of the other credits that happened in 2019. So there's been a lot of people that have utilized the efficiency credits, mostly when it comes to solar energy. We don't want to touch on it too much, but we just kind of wanted to let you know that that is still available for any improvements that were done in 2019. That credit is for up to 30% of the cost of it. but each year until 2021, that credit is reduced by a certain amount. So the credit is going down, and barring any tax code changes, it'll be completely phased out by the end of 2021. So that's kind of something, as Jesse and I were putting this presentation together, we almost need a disclaimer in all of our slides that say barring any tax code changes, because as we know, they can change yearly. We've had 2 big years for changes in tax codes. So, but we're hoping that next year there's not as many changes and it can kind of slow down. But barring any tax code changes, these are going to sunset kind of at the end of 2021. Additionally, under the Affordable Care Act, it was mandated that everybody has health insurance, and there was a tax penalty if you did not hold health insurance for yourself or your household. So while that mandate is still in place, that everybody has to have health insurance, there is no longer a tax penalty if you do not have it. So in 2019, on your 2019 return, there should not be any tax penalty for not having health insurance. Additionally, the contributions to your IRAs were changed a little bit. So previously, you were only allowed to do $5,500 a year if you were under the age of 50, and it was $6,500 a year if you were over the age of 50 due to the $1,000 catch-up amount allowed. That is increased in 2019, so now you're allowed a $6,000 contribution to your IRA every year if you're under the age of 50, and a $7,000 contribution to your IRA if you're over the age of 50.
Yeah, and the only other thing I would add on this slide is that solar credit or the general efficiency credits are for your federal tax credit. So they don't count to offset self-employment tax. So that is an important thing to note as well. So we'll move on to a little bit more about what happened in 2019. So the Secure Act was passed in December of 2019, but it is not effective until 2020's tax year. So this allowed for the required minimum distribution, which is what you would need to normally take out of an IRA at 70 and a half, to be extended to 72. So you don't have to start taking out quite as early. You can also continue putting into those IRAs up until the age of 72 as well, as long as you're still working full time. And then there was this additional piece that said, hey, beneficiaries now are required to take out the distributions within 10 years. Prior to that, you could take your entire lifetime to take those distributions. But now they're saying, hey, we need you to pull those, distribute all those funds within 10 years, unless you are some of these exceptions we have listed here, and they have several more of them, but surviving spouses, chronically ill, disabled, or minor children would have more than the 10 years. But we just wanted to kind of briefly go over that. That was a change, and we do have several people who would kind of be fitting into some of these different pieces. So we thought maybe some of you would be in that boat as well. So we'll go ahead and move on here to our next poll question. So when is the actual 2019 individual tax deadline? This one's kind of a tricky one. This one's just been, well, Emily, we've been living in tax season for a while now, haven't we? So
yeah, we definitely have. Usually we're used to wrapping up taxes much sooner than we were today. But as we'll go into here shortly, we'll start talking about the CARES Act and kind of all of the stimulus packages that came out due to coronavirus. And all of that has affected when taxes are filed, as well as many other things. So it's been an interesting and unique year, that's for sure. And I've said a lot that, I've now had 2 tax seasons under my belt, and each of the tax seasons have been very unique in the fact that there have been a lot of changes and a lot of things happening. So I'm hoping the 3rd year is the charm next year, that maybe it won't be quite as unique and we'll have more of what's considered a normal year for taxes.
We hope so as well. And I've been doing taxes just slightly longer than Emily has. And so last year, her coming into tax season with a brand new set of rules, she probably felt more comfortable with those rules than I did, because I kept thinking, man, is that the prior tax law? Is that this tax law? So there was a lot more time spent researching and reading those regulations to make sure we were getting that right. But it looks like we've got a lot of people voting in here, and yes, July 15th, today is the day So we are very excited about that. We are feverishly, or have been feverishly, finishing just a few things here in our office, but we're excited to move forward to tomorrow. So we hope that you all are too, and hope that we don't have to deal with such a crazy, crazy event next year.
And we can start catching up our years. As of the end of today, we will be able to start looking at 2020 again, as opposed to looking back to 2019.
Yes, exactly. So as we just mentioned, the filing deadline is today for federal and Illinois taxes, and then your estimated payments. So the first 2 quarters, so we do have some people who pay quarterly taxes. The first 2 quarters for the federal taxes are due today. And the prior to for, I'm sorry, not the prior to, but for Illinois, the first 2 quarters were still due April 15th and June 15th. So that was a little bit confusing that Illinois didn't follow suit with federal. So we did have some questions about that, but we're going to be happy to be caught up today and just moving forward. We will hopefully, as Emily said, be able to live in 2020 again with the rest of the world. So we're excited about that. Emily, I'm going to let you talk a little bit about these RMDs and kind of what we're going to do about those. So we're just going to briefly hit on a couple pieces here.
Absolutely. So before I move on to the RMDs, I will quickly just say that the deadline to contribute to your HSA and your retirement accounts was also extended until today. So if you were expecting to make a contribution for 2019 to your HSA or retirement account, all of those have to be done today as well. So make sure you're on top of that. And then moving into the RMD, we talked a little bit earlier about how the Secure Act changed what those required minimum distributions did. Well, part of what the CARES Act did, the coronavirus stimulus package that came out, was waived those required minimum distributions for 2020. So if you would normally be required to make one, you do not have to make one in 2020 unless it is part of a defined benefit plan. It also extended, there was an IRS notice that came out in June that basically extended the rollback of a required minimum distribution. So if you had already taken your required minimum distribution before the CARES Act came out that had waived the requirement to take those, you previously had a shorter time frame to roll those back into your retirement account without having any penalties. Well, that deadline is now August 31st. So if you have taken a required minimum distribution and you think you want to roll that back, you can now do that up until August 31st of 2020. In addition, it changed some of the penalties associated with taking money out of your IRA. So if, say, you needed to take a distribution from it that you normally wouldn't have, an early distribution from it, it waived the 10% penalty fee that you would normally have to pay on an early withdrawal from your IRA. It also allows you to pay the income tax liability over 3 years or return all of those funds to your IRA within 3 years without having to pay taxes on them. So it just kind of extended or made it more flexible to get money in and out of your retirement account due to maybe tight money situations from the coronavirus.
Yeah, and so there were also some different pieces in that CARES Act about payroll tax liabilities, as well as retention credits. So not everyone has payroll. I think there's just a couple of things we want to highlight here. So if you do have payroll tax liabilities, you will want to make sure to be working with your accountant. If you were affected by the coronavirus, there is a potential that you can defer the due dates to and still avoid penalties. So we just want to make you aware of that and just let you know to talk to your tax accountant about that, as well as these employee retention credits. So they're fully refundable, but it's only eligible for businesses whose operations were fully or partially suspended by COVID, which means in Illinois, agriculture is out because we were considered essential. So when I say we were, Emily and I were also considered essential. So that kind of includes us in that boat as well. So just wanted to make you aware of those two things, just briefly touch on those. And we'll go ahead and move on into some additional pieces of the CARES Act that a lot of people have questions about, right? So what is my economic impact payment? When am I going to get that stimulus check that everybody keeps talking about? I haven't gotten mine. Where's it at? When's it coming? So there were a lot of confusing pieces about that. You could go to the IRS website and update your information and they direct deposited. Maybe you had your check direct deposited from last year, so maybe they already had your information from your taxes in the prior year. But needless to say, There was a $1,200 per individual non-taxable stimulus check that came for our, well, pretty much anyone in the United States. We'll talk about that in just a few minutes as well and give you some more details about that. And then $500 for each child that was under 17. So we get a lot of questions from, kids and their parents who maybe they claimed last year, but they didn't claim in 2019, or they didn't claim, or they don't plan to claim in 2020. Well, what's important to remember these are 2020 stimulus checks. So when we do your taxes in 2020, all of that should be trued up. So generally speaking, our understanding is that at the end of doing the 2020 taxes, those stimulus payments should be trued up based on your specific need, whether you should have been an individual or whether you should have been independent. And then we have these things called the Economic Injury Disaster Grant / loan. So the economic impact payments came from IRS, and these EIDLs and EIDGs were from the Small Business Association. So we got two separate things going on here. So you could have gotten an advance up to $10,000, which is $1,000 per employee, which is taxable. But the loan advance doesn't have to be repaid. So it's technically called a loan that's turned into a grant. So that was a little bit confusing in the wording, but we just want to make sure to let you know that specific thing, that specific piece, the economic injury disaster grants, should not be repaid as a loan, but they will be taxable on the 2020 tax return.
And these would be eligible for anybody who has paid employees, or if you are a self-employed individual. So if you are a sole proprietor, self-employed individual filing a Schedule F farmer, you would have qualified for $1,000 of a loan advance that does not have to be repaid.
Perfect, thank you, good addition there. Go ahead, I'll let you talk about the Paycheck Protection Program.
So this Paycheck Protection Program kind of consumed our lives for about 2 months, where we had a lot of people trying to figure out what all of the requirements were, who was eligible, read through all of the nitty-gritty details that the IRS and SBA was putting out there. So this program was also through the Small Business Administration, and it was designed to help keep employees on payroll for different businesses who either had to operate at reduced hours, reduced capacity, or had to shut down altogether. So it was an eligible loan amount based on 2.5 months of payroll, or if you were a self-employed individual, 2.5 months of your net self-employment income based on your 2019 tax return. There's a potential for full forgiveness if you had it based on 2.5 months of payroll. At least 60% has to be spent on payroll. This has changed in the last 2 months. It started out as being 75% on payroll and 25% on rent, mortgage, interest, or utilities. That has now changed to 60% on payroll, 40% on rent, mortgage interest, or utilities. The current deadline for the application is August 8th. So if you haven't applied and you think you might be eligible, you can talk to your banker about it. You have until August 8th to apply. And any amount that is not forgiven is put on a 5-year loan at 1%. And you have 10 months after your covered period to submit an application for forgiveness. Now, when we say covered period, we're talking about the amount of time that the loan forgiveness period is for. So if you received your loans after June 25th, you're automatically in the 24-week forgiveness or covered period. If you received your loan amount before June 5th, you can choose to be in either the 8-week forgiveness period or the 24-week forgiveness period. But that is probably a decision that'll come between you and your banker to determine which one is going to benefit you the most.
That's right. So you'll just want to make sure and, clearly state, hey, I either got my money before June 5th or after June 5th. So just to make sure that you know what that is and that you're communicating with your banker about that. All right, so we have another poll question. How many of the following stimulus payments did you receive? So we've got several checks, or several that we've talked about. PPPs, EIDLs, EIDGs, and then your economic impact statements. So the Paycheck Protection Program has been extremely popular, as we mentioned. Emily and I work with a lot of self-employed people, so it was really great to see that the government was working to infuse capital into our local and national businesses. So we've been very happy to help with that. That, like she said, that did take up quite a bit of time. That kind of was a little bit of a relief. I think we're back, Linda.
Good deal. Okay.
Okay, I'm so sorry about that, everyone. We are having some thunderstorms in our area right now, so we apologize for the technical difficulties. And we will go back to our presentation here in just a second. Let's see where we're at. Emily, let's close. Oh, sorry about that, guys.
We'll get there eventually.
We'll be right back with you.
Our preparation did not include a huge thunderstorm knocking out our internet for a minute.
That is true, but that's okay. You know what? You just go with the flow and everything's going to be fine. That's what my nephew always says. Everything's going to be fine. So just give us one more minute here so we can get to our proper slides here. And we will swap here, and I think we're back and rolling, and we will cross our fingers for no more of that. So we already went ahead and did the poll question. As we mentioned, we wanted to just talk briefly about the stimulus impacts. So as you can see here, as I mentioned before, the economic impact payments are from IRS. So this information came from the IRS's website. So the number of payments issued has been about 5.7 million. And the amount of payments have been about 9.6 billion. So we've got a lot of money that has been infused into the pockets of the citizens of Illinois. PPP approved loans, about 202,000. I know on the poll before we got cut off, the PPP was a pretty popular answer. So we're seeing about 22.5 billion infused into our local businesses, as well as for the entire US. About 521 billion of payments issued, and then just specifically for the ag sector, almost 8 billion. So that's really great. Those of you, as Emily mentioned, who haven't applied for a PPP yet, there's still money in the pot to go do so, and you have until August 8th. So we just wanted to briefly go over those and let you know what's happening and how that is impacting our businesses around here.
We'll just briefly mention this. We don't want to get into the nitty-gritty details of this because it kind of gets down in the weeds. But if you know that you have a net operating loss on your tax return, there's something in the CARES Act that allows you to carry that back instead of having to carry it forward. So we would just suggest that you talk to your tax accountant about that if you are aware of the net operating loss on your return. Other than that, we don't really want to spend a whole lot of time. We just wanted to make sure that you knew this was available if it applied to you.
Yes, absolutely. So then we know that there was also this Family First Coronavirus Response Act. There are some additional pieces into this act that says, you know, if you were sick with COVID, then there are some additional pieces that your available benefits will cover, as well as some expanded unemployment benefits. So just wanted to make you aware of that in case that did affect you. There is some specific pieces for that. So just wanted to throw that out there briefly. And then we just want to move into a little bit more now about kind of what taxes are and maybe what they would be depending on what kind of entity you want. So we're going to start with that discussion now.
Yeah, absolutely. So we get
we're going to ask you to,
what should my adjusted be?
Oh, sorry, what, Linda?
We're still recovering from the electrical outage, and you'll need to take your screen off of the quick poll and start advancing slides. There we go. Got it.
Okay.
Now we see what age should AGI be. Thank you.
Okay.
Perfect.
Thank you for letting us know. I appreciate that. All right. Sorry for all the confusion, you guys. This was just a crazy one-off event here that happened. We haven't had rain in days, and now we've got a thunderstorm just during this particular time. So thank you for bearing with us. We're so sorry for all the technical difficulties. So we'll talk a little bit. Go ahead, Emily. What should my AGI be?
Yeah, so we get that question a lot. What should my adjusted gross income be? What should I be paying taxes on? And we generally say that your adjusted gross income should be equal to your family living plus your income tax liability from the previous year, and then the principal payments that you have / depreciation. So those are all your non-deductible expenses, which means you have to bring in income to pay for those expenses and you can't deduct them on your return, which means that if you are not paying tax, or if your AGI is less than those three amounts combined, you're generating what is called a tax deferral, which means you're just pushing the can down the road. Eventually, it's probably going to come back. So that's what we generally suggest, is that you should be paying taxes on those three amounts combined, what your adjusted gross income should be.
Absolutely. So now we're going to talk, as we mentioned, a little bit about entities and some tax implications of those. We've just listed here three main entity structures: partnerships, corporations, limited liability companies. And when we talk about partnerships today, we're going to be mentioning that in regards to a split Schedule F. And a limited liability company is something that would default to a partnership or a 1065 tax return, for those of you who do have a partnership and are familiar with that term. So we want to just show you here briefly. So in an entity overview, just some things you may want to keep in mind. Split Schedule Fs are going to be generally much easier to deal with because you won't have annual compliance, you won't have organizing documents, or have to actually be registered with the state of Illinois. But everything else will be pretty similar as far as needing to file a tax form at the end of every year, making some capital contributions, and having some different tax implications based on the type of business that you have. But we did just want to throw up this brief slide here so that you guys can have that for later to review. And if you do have any questions about that, we are more than happy to answer those as well. We just also wanted to throw a quick slide up here about how people would get cash out of their different types of entities. Distributions are very popular for a lot of our pass-through entities. C corporations, it's a little more difficult because you don't necessarily distribute money. You would have to pay those out in wages or dividends. Those are kind of some of the more popular types of ways to distribute cash, as well as potentially to pay rent to yourself if it's a self-rental. So again, those are just kind of up there for reference, and you can look at those and ask us questions. We'd be happy to answer those as well.
So we're going to go into kind of a case study just briefly here. So we're going to say that Squints and Wendy P want to go into business together, and their business is going to be 50-50. They're going to have equal contributions in, and the return on it is going to be equal out. They want to know which entity structure would be best for their purposes, both for tax and long-term planning. So we're going to assume that in 2019 they had total farm income of $150,000, and then they had another 100,000 of machinery sales. So as we talked about earlier, the characteristic of the income matters in regards to whether it's self-employment tax or just ordinary income or capital gain income. We're going to assume that they have no other non-business income, meaning the only income that they need to report on their tax return is the farm income and the machinery sales. And we're going to assume that they're both single filers with no dependents. Their individual tax returns would look exactly the same based off the income they have.
Yeah, so we've just got listed here what that might look like, what their tax result might look like if they were a split Schedule F. So it's important to note here that we are showing only one of their tax liabilities, so not both. And then on the C corporation, that would be the total of the tax liabilities. Mm-hmm. So in the split Schedule F, you can see here that they'll have self-employment tax of about $10,600. They'll have some federal tax, almost $15,000, state tax as well. So total tax of nearly $30,000, which is the same result as if they were in an LLC. If they were in a C corporation, their tax liability would be about $38,000 total, because that is at a lower tax rate, but it's 21% flat tax, right? So we can see here, and we'll kind of go through a little bit more about the different types of taxes that are included in that effective federal tax rate at the bottom. But I just want to finish kind of going from left to right here. So in the S corporation, you can see that the total tax is about $22,000, and that's generally speaking because they just don't have the self-employment tax attached to that. So let's kind of go back and talk a little bit more about what that all means, right? So if you're in a partnership or if you have a split Schedule F with someone, you would have to pay self-employment tax, you would have to pay federal tax at your tax rate, and then you'd have to pay the state tax. So with our current tax laws, the effective tax rate is a little bit less than it would have been before because we have that qualified business income deduction. So the effective federal tax rate is essentially your federal taxes, self-employment and federal tax together, because you pay those both with your 1040 federal tax return, divided by your total income. So the numbers that we see here just reflect both of those, as I mentioned, federal and self-employment tax. So about 30% tax, federal effective tax rate if you are a self-employed individual with a partnership or a pass-through Schedule F. And then, as we mentioned before, for the C corporations, they had a lowering of their tax rates. So they had a progressive tax rate before. So the lowest tax rate was 15%, and you had to have $50,000 of net income to be in that tax bracket. And as you moved up, it's just like it was just like the individual tax rates where your tax rates grew. So now that's all taxed at a flat 21%, which is why you see 21% here. And then the S corporations, as we mentioned, there's just no self-employment tax here. Everybody has the same total income, as you can see from our example, but the total tax can vary greatly depending on what kind of entity you have. So just being aware of the types of taxes and the character of income, as we mentioned before, so that you can kind of understand a little bit better how your taxes work and why your tax bill is either more or less than what you expected it to be.
Yeah, absolutely. And it's also important to note that this is a very simplified example. So there would usually be a lot more pieces into this puzzle that would make it a little bit more complex. We just wanted to show a pretty simplified version of how that tax can change based on your entity structure and whether it's taxed at your individual rates or like a corporation is a flat tax. So for your split Schedule F, an LLC, and an S Corp, those are all, the income from those are all going to be passed through to your individual return, and you'll be paying your individual federal tax rate on them.
Yeah, so we're going to go ahead and I'm just going to throw this up here as another poll question that we had. So which of the following entity structures did you utilize? So we can just go ahead and roll through this slide. We do have a lot of sole proprietors. That's something that we haven't talked about. But that's generally speaking are people who are just business owners. So all the farm operators we work with are generally sole proprietors in one way or another, and then they may have another entity as we have listed here. So next, Emily and I just want to briefly kind of go over a few of these points. I know we're kind of running low on time here, so we'll go through these a bit quicker than what we probably would have. So we just want to make sure that you're utilizing these entities for your best strategic plan to your best strategic business plan to transfer assets between generations. So we don't want you to say, hey, I want to create an S corporation because I know I don't have to pay self-employment tax and I want to get out of taxes today. Well, that may be okay, but we want you to just really know whether or not that's what you want in your operation going forward for the next 20 years. So that's really what we're interested in, is how can we help you be successful in tax planning for your business operation for the next 20 years. As we mentioned, the change in the C corporation tax rates were favorable for some, not favorable for others. So for our really big organizations, that could have been a more favorable tax rate because they had higher income. A lot of family farm owners and operators generally were wanting to stay in that low 15%. So they may be paying a little bit more than they had before. So as we mentioned, unfavorable for some, favorable for others. There's also something inside of C corporations called the built-in gains tax, or the big tax. And we just want you to be aware of that. If you are trying to sell assets out of a C corporation, there could be some additional taxes for you to be aware of. The next thing we have listed here is reasonable wages. And that is just to note that if you have a C corporation or an S corporation, you just need to be making sure that you're paying reasonable wages for the amount of work that you're doing for the operation. That's part of the compliance with just having one of those types of entities. So we want to make sure that you're staying in compliance with that. And then I'll let Emily talk about the rest of these here.
Yeah, absolutely. I'll just try to go through these very briefly. So record keeping becomes even more important when you have an entity, just because of what is called the corporate veil of protection. So one of the reasons a lot of people want to form an entity is to help limit their liability. And we see that a lot, especially with somebody who has maybe a trucking company in addition to their Schedule F, or maybe they have a hog operation with hog barns or something else that would increase the liability that they might have. So if you have especially multiple entities, it's important to keep the record keeping separate if you're trying to limit liability, because if you start intermingling, sets of books, and something were to happen to an employee or something happened to you out on the road, and somebody were trying to sue you and your record keeping was intermingled, they might say that you pierced the corporate veil of protection, and they could potentially come after more than just the assets that are within that limited liability company or within that entity. Another piece is what's called a disregarded entity. So it's possible to have an LLC that is considered a disregarded entity. And what this essentially means is you would just report all of the income from that business on your individual Schedule C to be reported on your 1040. It does not require a separate tax return. You still have some protection for being in an LLC for liability. But you don't have to file a separate tax return. All gets reported on your individual 1040. And then like Jesse was talking, just a strategic business plan moving forward, we want to make sure that these entities set your operation up for long-term success and not just tax mitigation. So it's important to always be thinking about what your long-term goals and objectives for your operation are. And as we kind of talked on earlier, the tax code is always changing. So just because something is favorable today for tax rates does not mean that in 5 or 10 years it's going to be favorable. So always making sure that you're keeping that in mind when we start talking about using entities to assist with tax situations.
All right, now we have some time for questions.
Very good. So thank you, Jesse and Emily, for that insightful presentation, the expertise and the experiences that you shared, and weathering the storm. Rain is usually welcomed, and we heard when it was rolling in. It's a big front that's moving in. We have a little time now for questions, and we have a couple that have been sent in here. So here's one. With Illinois ground being some of the best soil in the world, owning about 450 acres could put you above the state level of 4 million. In present times, 400 acres is not a lot of acreage. So why has the state tax level not been increased?
That's a good question, and we have the same question. I unfortunately don't have a good answer for that. That's just historically not changed. We would love to see that number go up. As you said, we have a lot of very high valued farmland in this particular state, and so we would love to see those estate values cranked up, as far as the estate exemption values cranked up. So we will be praying for that. We hope that you are praying for that as well, and that we can see that moving forward.
Okay. With permission here from the audience, since we had a little technical storm difficulty, we've got one more question here we'll take time for. Here it is. I received a letter that my deceased mother will be getting a payment. I have not received a check and her bank account is closed. Who do I contact?
Well, I think there's a number that's probably listed on the IRS website that would assist with that. I don't know that I specifically know the number to contact, but there should be one on the IRS website that talks about what to do if a deceased family member or somebody who has passed away either receives or gets one of those letters. So I would say I probably refer you to the IRS website for that. There should be an FAQ sheet on there that talks about what number to call or where to send money received back.
Yeah, so Emily's exactly right. If you do not want to deposit that money, you will want to send that back. I think they were very clear on that in those FAQs, but that will just keep you in compliance with them. So I would just Google up FAQs, economic impact statement, or economic impact payments on the web, and then find that on the IRS website, frequently asked questions. So I absolutely agree. I think you'll find a good answer there with a number to contact.
Okay. Very good. Very, very helpful thoughts there. That's all the time we have for questions. So thank you to our sponsor for this session, Country Financial, and thank you to our AMP partners, Illinois Farm Business Farm Management, the University of Illinois Farm Doc Team, and the Illinois Soybean Association Checkoff Program. The recording of this presentation will be posted to the ISA webinar archives on YouTube and sent to all the attendees via email this week. So please stay tuned for the follow-up here. Take a few minutes at the conclusion of this webinar to answer the survey, and we appreciate your time. Your feedback helps us to continue to improve the program and our resources that we can deliver to you. We hope to see you back next week for another AMP webinar double feature on July 22nd at 9 a.m. and 10 a.m. And you can find more information about those webinars at ilsoyadvisor.com. So thank you all for attending today and have a great day.